Winter is one of the best periods for trading GER40. That is why I decided to record a video specifically about this index, to show why winter offers the best conditions and how to trade correctly during this period so as not to fight the market, but to use its behavior to your advantage. Another important point I want to highlight here is the ability to adapt to a specific asset in a timely manner. Many people underestimate this skill. They trade using the same approach in any market and in any season, and then wonder why their statistics are falling apart. In this video, I'll show how I adjust my trading logic specifically for GER40 in winter, and how this changes my choice of trades and the direction of my work. Let's start with why I focus on the winter period for trading GER40. If you trade this index for more than 1 year, it becomes obvious over time that its movement pattern changes in winter. This can be seen in the statistics and simply in how the price behaves on the chart. Even if you do a regular backtest, this feature will be clearly visible. Over the past few years, the GER40 has behaved in roughly the same way. Starting in the spring, the market usually enters a prolonged period of consolidation. The price remains within a range for a long time, in which the market alternately takes out liquidity from the top and bottom. But at the same time, there is no sustained movement in one direction. During such periods, the direction constantly changes, and the market redistributes positions rather than moving purposefully in any direction. Closer to winter, this logic begins to break down. After the liquidity within the range has been collected, the price stops returning to the middle of the range and begins to move consistently in one direction. It is at this moment that the market emerges from consolidation mode and begins to work out the direction. In general, this is quite logical. Even with a basic understanding of trading, it's clear that most of the time the market is in a sideways trend and accumulates potential, while the actual movement takes less time. But it's precisely these movements that are easiest to work with, because the market begins to drive the price more straightforwardly. At the same time, it's important to understand that just because this happened before doesn't mean that it will necessarily happen again this year. So let's take a look at the current picture on the chart. From June to December, we were precisely in this range. Those who have been following the channel for a long time know that I marked this liquidity zone as key. It is clear that after it was worked through, the market began to grow actively. It's also important to mention that when the upper limit of the range was reached, the price didn't return, but consolidated above it and continued to move. For me, this indicates that the market is no longer operating in a consolidation mode and is beginning to behave according to a different scenario, one very similar to what we have seen in previous winter periods. That is why my approach here is as simple as possible. Until the market shows otherwise, I'm only considering trades in the direction of this movement. I'm not trying to guess the peaks, and I'm not looking for a counter trend. I'm simply working with the context that the market is currently providing. I know that many of you already want to get down to specifics and see exactly how to trade. But, as I always say, it's important to understand the logic first, and the model will naturally grow out of it. So before I show you how I plan to trade GER40 in the winter, I want to focus on one key topic, the ability to adapt, because this is where most people make mistakes. Adaptation, in my understanding, is not about changing your strategy every time or coming up with new entry models. It's about something else. It's about the ability to work with the current context, not against it. During the consolidation period, there could be only one logic. Consider shorts after removing liquidity from the highs of the range, and longs after removing liquidity from the lows. This is normal because the market didn't have a clear direction. But when the market leaves consolidation and begins to move in a real direction, the approach must change. At this point, there is no point in continuing to trade both sides. The focus should be only on trades in the direction of this movement. If you watched my video on gold, you'll remember a similar situation. At that time, the asset grew steadily for about 2 months, and I showed how, in such a context, it makes sense to ignore counter-trend ideas and work only in the direction of the trend. The logic here is exactly the same. Next, we'll move on to how this looks in practice and what scenarios I'm considering for trading GER40 in winter. Well, now we can move on to trading itself. I've already managed to take 2 trades this week, so I'll use them to show my logic and how I plan to proceed. The first thing I've already decided for myself is that I'll only work long until the market shows otherwise. This is a basic filter, without which there is no point in considering anything further. Further, all trading is built around the London session. This is when the most active time occurs, and most often, the movement that can be realized within the day is formed. There is one key condition without which I don't consider trades at all. I need to see that during the London session, liquidity is withdrawn from the Asian session low. If this doesn't happen, there is no trade. Everything else is secondary for me. When this condition is met, I switch to a 5-minute time frame and continue working with entry models. I use two models in my trades. I'll show both. After liquidity is withdrawn from the Asian low during the London session, I wait for the fair value gap to form. As soon as the price returns to this FVG and starts to move out of it, I open a long trade. In this model, I set the stop behind the liquidity withdrawal zone and the take at the current high. The model is quite classic and familiar to many, so it's important to understand the logic rather than the form of entry itself. The sequence is always the same: liquidity withdrawal in London, FVG formation, test, entry based on context. The second model is used less often. The logic is the same. We wait for the London session to take out liquidity from the Asian low, but if FVG doesn't form after that, I may consider entering when the price returns to the Asian session range. For me, this is confirmation that there was a reaction after the liquidity was removed and the market continues to operate according to the context. In this case, the goal remains the same: the maximum of the Asian session. Let me clarify one thing. I consider this model to be more situational. It depends more on price reaction, structure, and risk-reward ratio. For this reason, my recommendation for most traders would be to focus on the first model, as it's simpler, more stable, and easier to interpret. The key factor here is not the models themselves, but the filter. As long as there's a long context and London removes liquidity from the Asian low, the trade makes sense. I simply disregard everything else. The main thing here is to understand one basic thing. Context is always primary. Entry models, timeframes, and specific sessions only matter when they fit into the overall market direction. For those who still find it difficult to read the logic of the trend and context on their own, you can use the OWL indicator. Just to clarify, this is not a smart money indicator. OWL is a trend tool that helps to structure the market and work in the direction without a deep analysis of liquidity and session logic. It shows ready-made levels for opening a trade, as well as where to place stops and takes according to its logic. That is, you immediately see the direction, entry point, and risk, instead of having to start from scratch every time. As usual, I'll leave a link to OWL in the description below the video. Now, since many of you trade cryptocurrencies, it's important to understand that the same logic applies to the crypto market. The principle remains the same. Learn to see when the market leaves the waiting phase and real movement begins, and then work only in that direction. The only difference is that in crypto, it makes less sense to be strictly tied to trading sessions. The market operates 24/7, so the key is the direction and goal of the movement, not the specific time. I use Evedex for trading crypto. It's a platform where you can work calmly in context. You simply connect your wallet and trade according to your logic, without verifications, limits, or unnecessary restrictions. The interface is simple, the execution speed is normal, and the commissions are reasonable, which is important if you work intraday and with precise entries. As usual, I'll leave a link to Evedex in the description below this video. In the end, all this logic comes down to one simple thing. Context is always primary. Not the entry model, not the time frame, and not a specific session, but an understanding of what mode the market is currently in. GER40 in winter is a good example of how asset behavior changes over time. If you can notice this and adapt, trading becomes easier. There are less trades, but they are more meaningful and fit better into the market movement. The same applies to other markets. It doesn't matter if it's an index or crypto. First, the direction and logic of the movement, and only then the search for an entry point. If you found the video useful, please support it with a like and a subscription. In the next videos, we'll continue to analyze how to read the market consistently and make decisions based on context rather than gut feeling.